the energy prices, the oil prices is falling a lot, especially in the morning. So 4% falling. It's not sufficient to slow down the inflation enough. Do you think?
I don't think so. Policymakers and investors as well sort of tend to look through changes in oil prices because we understand how volatile they are and that they're therefore not a great predictor of the trend. But oil prices were largely behind that month-over-month decline we saw in inflation in July. We know that they have continued to fall, so presumably they're going to be a big help for August, but we can't count on, they've gone from $110 to like 85 now. We can't count on them going to 60 in another 2 months and 35 another 2 months after that. We think inflation is going to ease because of really two things. One on the supply side, which is that the bottlenecks are being resolved in terms of production and transportation around the world as the pandemic COVID goes from being this acute threat to human life to being a nuisance that we can manage. And as that happens, you won't have these interruptions to production schedules. You won't have as much difficulty in getting goods onto a ship at a port and unloaded where they come off. And so these bottlenecks are going to keep easing. That's going to help. There'll be more supply. Then on the demand side, we expect demand for goods will continue to abate as now that the economy is fully open and consumers are able to regain their full range of options. They didn't used to be able to go to a restaurant. They didn't used to be able to go to see a concert or a sporting event or a movie. Now they can do all those things. They didn't used to be able to travel. So we do expect that we're going to continue to see a shift in demand away from goods where there were shortages to services. And that those two things, the easing of bottlenecks and the shift in demand from the really hot inflation spaces will allow inflation to come down a good bit, from now to the end of the year, and that, as we see comforting, welcome consumer price index reports in September for August, in October for the previous month, September, in November for October, and December for November, perhaps that will allow the Fed to meet its criterion of clear and convincing for inflation declining, and that's when we'll be able to get to the Fed hiking by just 25 basis point increments and eventually even pausing to say, okay, you know what, we've gotten the Fed funds rate, I'm just picking a number here, we've gotten the Fed funds rate to 3.5% or 3.75% or 4%. Now we're going to step back and see how that is affecting the overall economy, and if indeed that has slowed the economy enough that we don't have to continue to 4.25%, 4.5%, 5%. And that, ultimately that's when I think we'll see some relief in financial markets as it becomes clear that that's the trajectory where inflation is headed and where Fed policy is headed.
Many market groups think like that, but there is two clear threat about it. So one is China, and China continuously keep their zero COVID policy. Still lockdowns happens in major cities, and the other is Putin. Putin says if the price capping mechanism started and they won't supply any gas or the gasoline or crude oil or something like that.
Right. I think if I can take the second one first, in our view at BCA, capping the price of a commodity is impossible because, if Europe and the United States say they will not pay more than $65 a barrel, $75 a barrel for Russian oil, they have no way of enforcing that around the whole world, right? Prices for these commodities are set globally. And that if China and India, for example, are not participating in that, then Russia can very easily put the barrels of oil on ships heading east, heading that way, east and south to Russia and China, instead of west to Europe or the United States, etc. So we don't think Russia will have to take really severe actions to cut off the flow of gas to pressure the West, because the West mechanism we think is doomed to failure. We don't think there's a way to enforce a cap. And therefore, I think we can go along with the way things are now, that the Russian oil is being sold and China and India are winning because they're getting this at a discount, but not nearly as much as the discount that the West seeks to impose on that Russian oil. And if we continue to see things like truce isn't the right word, but the abandonment of hostilities in a corridor that allows grain shipments to get out of, that allows grain to get out of Ukraine and be put on ships around the world, that's going to keep easing food prices around the world, and they're already off considerably. If we get, wheat and corn are important for food prices globally. If that continues, then there's some progress there on the inflation front. With the China shutdowns and lockdowns, zero COVID, continuing to pursue zero COVID, that is much more of a challenge, and it strikes directly at what I was suggesting for supply bottlenecks easing, right? Hopefully, and this is our base case, so hopefully our base case pans out, that China can have effectively rolling lockdowns. So you lock down 1 or 2 cities, but there are 16 others functioning. Then you move on like a rolling blackout, right?
Now the August job report released, and the August CPI will be announced soon. What decisions do you think the Fed will make at the coming FOMC? Why do you see it that way? 50 or 75?
The Fed has begun to slow the pace of increases. I don't think we can count on that. I think it's as likely that we'll get a 75 basis point hike as a 50 basis point hike. But as we look to the last 2 meetings, the remaining 2 meetings in 2022, and then into 2023, the Fed's not going to be hiking by 75 basis points every meeting. So there will be a diminution of the hikes that presumably foreshadows an end to the tightening cycle. But again, I think it's premature to think that we're going to get there, because inflation hasn't yet been tamed, hasn't yet been demonstrably tamed. And until it is, the Fed is signaling that, hey, we're not going to back off.
And that means, do you think this is the unusually large hike in September will be the last one?
Yes.
Maybe over the 50, right?
Yes, I would. That is my base case. That's the base case of my colleagues at PCA. Now, of course, things can happen that change that. We are as data dependent with our expectations as the Fed is with what it does. But yes, we would expect that, because we see the trajectory of inflation slowing, and because we think it is going to continue to slow as goods demand moves to services demand, and as we see these supply bottlenecks and transportation bottlenecks around the world being relieved, that it will give us confidence that inflation is heading in the direction that everyone wants it to.
And Fed members are predicted in a dot plot in June that the policy rate would rise to 3.4% this year and 3.8% next year. How do you see this dot plot changing at the September FOMC, and what do you think the final rates will be?
I do think they will. The median expectation of the Fed funds rate at the end of this year will rise. Right now,
over the 4%?
Above that 3.4, well, above the 3.4 where it is now, because it's only every other meeting that we get a new dot plot summary of economic projection. So it's been since June. And the Fed was concerned enough to have a 75 basis point hike in July, which I don't think it anticipated when they were voting in June on the summary of economic projections. And we may indeed have another one in September. So right now, given that the Fed has hiked by 225 basis points so far this year, the Fed funds target range is 2.25% to 2.5%. Okay, so rounds to 2.4, 2 3/8. If we get 75, we're going to be at 3.25. And then if we get 50 in the next meeting, that's 3.5 to 375, and if we get 25 basis points at the end of the year, it's 3 3/4 to 4. Right? So it does seem likely to me that we're either going to get 75, 50, 25 the rest of this year, an additional 150 basis points, or 50, 50, 25, an additional 125, and that's going to have us, if that lower expectation of 125, then we're going to be 3.5, 3 3/4 at the end of the year. So that, that implies we're going to be at 3.6. That number's got to come up by at least 25 basis points, maybe by 50. Presumably then the year-end 2023 rate would move up about as much as the 2022 expectation does. And we think that's ultimately the big surprise for markets, is that the Fed is not going to begin cutting rates in 2023. To this point, the money markets are still,
Do they think the fourth quarter of
right, they're expecting
they will cut?
Yep. Now, after the July meeting, they were thinking it would begin in like February or March, right? And now the markets have moved that out, exactly, pushed it out back about 6 more months. We don't think it's going to happen at all in 2023. So ultimately, because we think the Fed will have to take the funds rate above 4% to get inflation on the way, clearly on the way to the 2% target, that, we think once that becomes clear, financial markets will suffer a little bit.
And that means you're seeing equities will gonna fall to the end of this year?
No,
And
I think they'll rally. I think they'll end the
From
year.
now on?
Yes, so we're at 3,900 around 3,900 now. Yeah, I think they're going to end the year a meaningful amount above 3,900. I guess it would take 400 points from there to get to 10%. But yeah, I don't think there's any reason we can't end the year around 4,200, 4,300. And that's a meaningful rally. 300.
how about the next year?
I think then they can rally into the early 2023, but I think the big turning point, the big inflection point, will be when markets come to the conclusion that we have, that the Fed funds rate is going to peak somewhere above 4%, and that there are not going to be any rate cuts in 2023. So maybe the S&P 500 rallies into the mid-4,000s into the first quarter or second quarter of 2023, but once the market then says, well, we've got to discount the effect on equities, the effect on bond yields of the Fed continuing to hike up to 4.25, 4.5, whatever that level is, then I think you have a repricing and equities sell off again.
Got it. You think the recessions will come at the later part of next year, right?
I would say
And it will be mild and short.
1 year from now at the earliest. Okay, so let's even make it 13 months to get into the fourth quarter. I'll say the fourth quarter of 2023 at the earliest, if not, the first quarter, second quarter, third quarter of 2024. Now, we'll see what happens between now and then, but for now, that's my base case, is that a restrictive Fed funds level is somewhere north of 4%. So it will take, because of the lags, 6 to 12 months after the Fed reaches that 4.25, 4.5, whatever it is, before we really start the economy, we see the economy really start to slow down, and we actually have the recession begin.
Okay, I got it. You said rally from this time to the end of this year, but historically September and October had a lot of market crashes.
Yes.
Do you think it will be the same this year, or?
It would be, you'd have to have a pretty grim prognosis for both the economy and for stocks, given that this was the worst first half for stocks in 50 years or something. Like the double-digit decline we had in the first half, 17, 18%. I know we were down 23% in the middle of June at the trough. To be down 17, 18% in the first half is a really, really bad performance relative to history. To then have September and October have some sort of a crash in it, or another double-digit decline, gee, that would make for a really horrendous year for stocks. And to me, that's incompatible with what I perceive to be a fairly robust economy still. So just like Chair Powell at Jackson Hole, yeah, I think the economy's got plenty of momentum. And I think it has that momentum because households are in much better shape than is generally realized. That we estimate the $2.2, $2.3 trillion of excess savings American households accumulated in the aggregate that they would not have had if we had not had the pandemic. That will allow households to continue to consume at a rate that allows the economy to grow around 2% adjusted for inflation, so around its trend pace, despite the impact of inflation, despite the pressure of higher food and fuel prices, despite the pressure of higher rent, because they've got this sizable cushion to help them through it. And we've got a robust labor market with 300,000 some payroll gains in August after 500,000 in July. So I do think we can get through the historically fraught months of September and October across the rest of this year, simply because I think the economy, the underlying foundation of the economy, consumption, which is 2/3 to 70% of the US economy, I think that's really well supported. And that as long as that remains really well supported, we're going to stay away from a recession, we're going to stay away from meaningful declines in S&P 500 earnings, and that we will therefore stay away from a meaningful continued decline in stock prices.
Don't you think strength of dollar is excessive for the Fed, even if they want to lower the import prices? Is too much strength of dollar? Is that appropriate?
Perhaps. I mean, maybe they say, gee, this is, we believe that a stronger dollar tightens financial conditions. So that stronger dollar sort of, it piles on to what the Fed is doing, right? It helps tighten financial conditions. I think right now they prefer tighter financial conditions to easier ones. So I think they're happy to have that stronger dollar. They want to slow the economy. And so I think they'll take it for now. It's something that's helping them. And if it becomes a problem, then they'll adjust to that.
Okay. If you are right about the equity rally from now on to the end, to the next year, in the past, the midterm elections, after the stock markets rebounded after the midterm elections, and is there any, which timing is better, buy right now or after the midterm?
Yeah, I don't know. I'm not going to try to cut it that finely when I speak with clients. But what we have found is that typically the party that holds the White House always loses seats in the legislature in midterm elections. The way it appears to be shaping up, in the view of our geopolitical strategists, is that the Republicans are going to recover the House, the lower house in the United States House of Representatives, and it's very much a toss-up, the upper house, the Senate. And Democrats may be able to retain control of the Senate. But even if you have, if the Republicans only take one of the two houses of the legislature, you get gridlock, right? It becomes almost impossible. It's been very difficult to pass legislation with the Democrats with a 7 or 8 seat majority in the House and a tie in the Senate that is broken by the Vice President. So effectively a 1-vote majority, 51-50 in the Senate. If now the Democrats are going to lose their majority in the House, it's likely going to become impossible to pass any major legislation. And in general markets like that, right? In general markets like gridlock, because you can't have the country and the economy pulled too far to the left or pulled too far to the right. Status quo makes markets happy. That looks like where we're headed. If that's the view of markets now, that we're going to have gridlock, then you would think that gets priced in across August, September, October, and that we don't have to wait until after the first Tuesday of November to position a portfolio for it. Now, so I think the real big surprise would be if the Democrats retain control of both houses. But that seems like a small enough probability that we don't have to position for it.
Last question. you said the treasury yield will going down to the 3%. How do you see the 10-year yield is hovering around 3.3% right now? And do you expect it to rise above 3.5 and come down, or just coming down from now on?
I guess the former. Yeah, I don't think that all of a sudden we're going to snap our fingers and the 10-year yield is going to come down. We got to around 3.5% earlier this year. No reason, if you chart, a technical analyst would say, well, there's no reason we can't get back there. So sure, I think it can continue to be high, it can meander somewhat higher, or it could immediately go to around 3.5% before it comes down. But we don't think it has too much further to rise, that it'll stop somewhere around the peak that we've already seen this year, and will begin to make its way back towards 3%, which is where we expect it'll end the year.
Thank you very much for
Thank you very much.
your insightful answer. Thank you for being with us.
Yeah, thank you.